Morning. Oh man, it's good to be back, and it's good to be able to breathe again. I had to cancel the live stream from last week because I was just got done with surgery and I was recovering, and I had these stents in my nose, and I had to cancel it. Sorry about that, but yeah, didn't want to live stream and have you guys watch me breathe through my mouth, and it was just I was like, gotta cancel it real quick, but really happy to see you guys here. And hello from Ohio State. Hello, Art of War. And this is also being live streamed to the private group. So if you are interested in joining my private group, it is firesession.com/community. But anyway, welcome to the special live stream session. And man, am I super fired up to talk about the Federal Reserve's decision today with interest rates in less than 30 minutes at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. And this is also again being live streamed in my private group. So if you're interested in joining my private group, you can visit firesidechat.com/community. And Jerome Powell is also going to have a press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And I'm sure you have been seeing a lot of drama, right, between Trump and Powell. So I definitely want to hear what Jerome Powell has to say about today's decision to most likely maintain the interest rates at 4.25 to 4.5%. And more importantly, how is Trump going to react to Powell's decision today? And chances are the committee is not going to cut any rates today because of the labor market, right? And some of the data. And they're probably going to say that they want to see more data. And I'm sure Trump is going to come out with an angry post on Truth Social later on. And the committee itself is very, very divided right now. And about half of them say that they want to cut interest rates, I would say. And the other half would argue that they want to keep the rates steady at where they are. So that is something that the decision most likely is that they're going to keep the rates where they are. But just I want to hear what Jerome Powell has to say in the press conference on the justification behind the decision on maintaining the interest rates where they are. But anyway, so I mentioned my surgery just a little bit, but I had a surgery. Well, first, I want to say thank you to everyone who reached out when I recovered from my surgery last Monday. And I had to have surgery to correct a deviated septum last Monday, and I had a live stream scheduled for Wednesday, and I thought I was going to be fine. But by Tuesday night, I just decided to cancel it because one, I didn't think people would want to listen to a mouth breather, right? And I couldn't breathe through my nose for a week because they put these stents in my nose to keep everything together, and the surgeon cut out some cartilage in the back of my right nostril so that I can breathe out of both. And you probably didn't know this, but I spent some time in Iraq when I was on active duty to work the burn pit. And I've been having difficulty with breathing ever since. And I just held off on it for such a long time. And then eventually I couldn't breathe out of my right nostril at all. Like the right one was completely blocked. And the left one was the only one that I could breathe. And I'm a runner. I love running. And, it was just taking a very big toll on me. The ENT clinic stands for ears, nose, and throat. Took these stents out of my nose on this Monday, so that I can breathe so much better now. Did anything change since the surgery? I mean, yeah, I can breathe better now. I'm not doing this heavy breathing. I'm just breathing through my nose. But anyway, I just want to say thank you to everyone who personally reached out because that really meant a lot to me. But enough of that. I look pretty rough in that picture, but the surgeons, they were pretty they were concerned because they couldn't wake me up initially, but they think I probably have like sleep apnea or something. But something that I need to get it checked out. But I'm sure if you've ever done shift work, or if you ever worked all kinds of different shifts, or graveyard shift, chances are your sleep is all messed up, but yeah, again, I appreciate you guys. And just for the people currently tuning into my live stream, I want to thank you by offering a coupon code, free live stream, to get 20% off to join my private community or purchase my Fire Investing Academy. And this is the Fire community that you can see on the left-hand side of the screen. I post what you should expect every week ahead of the stock market, economic reports, and earnings. And I posted my thoughts on the Google earnings in that private community last week, and yesterday I posted earnings and my thoughts on SoFi. So, but anyway, if you look on the left hand side, I have the TSP circle. And let me see if I can zoom in. I probably can't. Nope. Okay, so left hand side here, you're gonna see different groups for people who may more be interested in like the TSP, HSA, Roth IRA, 401k. And then if you go to fireside.com/pricing, you're gonna see every tier that you can join based on your needs. So the private community is actually at the bottom tier, so you can get in for as low as $10 a month. So check it out when you get a chance. Okay. Anyway, all right, so back to the drama. But before I go into the drama, I really appreciate you guys being here. Thank you, brother. Stylo816, I really appreciate you. Yeah, I'm seeing some weaknesses in the housing market, slightly though, but it really depends on where you are. So I'm in Vegas. If you guys didn't know, in the Vegas area, it's man, it's becoming more on the buyer side, but I don't. The price is not. They're not dropping as much as you think. And one of the core reasons is the out of state people. They're moving into Nevada, and when let's say they sell a house in California and they make this, they make a profit for $500,000, they can come to Vegas and just buy a house straight up cash with 500,000. It's just an example, but it's just one of those things that I'm seeing is the buyers are still very active, and it really depends on the area, but we'll see how it goes. Housing prices, if they start to fall, let's say 10%, 15%, that's going to give buyers more purchasing power, obviously. It's going to be pretty difficult though, while the interest rates are still at 6.5, 6.4 for the 30-year fixed rate. So, we'll see how it goes. But anyway, all right, so back to the drama with the Fed. What I'm more curious about is the answers Jerome Powell is going to give to the reporters at the press conference at 11:30 a.m. Pacific Standard Time. And I don't think they're going to cut the rates at all today, unfortunately. But Trump has backed off a lot from the topic of firing Jerome Powell, because I'm pretty sure his advisors told him that he has no jurisdiction over the Federal Reserve at all, because it is an independent agency from the executive branch. And I was saying they tried their best to try to fire him, like really their best, right? And take a look at what happened. I don't know if you guys remember this, but when on July 16th, Trump actually tried to fire Powell. So 2 weeks ago, a senior White House official said to Republican lawmakers that Trump would likely remove Powell as Fed chair on that day. So that was on July 16th. And the report indicated that Trump even drafted a letter to fire Powell and showed it to Republican lawmakers during that meeting. And no one else knows how it all went down behind closed doors. But the rumor is that Trump was advised not to do this because it was a sure thing that he would lose in court. And this is how the market reacted right here on July 16th. That was that morning. And it started to crash when investors learned that the Federal Reserve was going to lose its independent status by firing Jerome Powell. And Trump is a big stock market guy. And if you've been investing for a while, you know this too. Even during this first term, he was boasting about how the markets, perform really well. And he's not wrong. Between 2016 and 2020, the stock market did really well, right? He might deny the fact that he's paying attention to the stock market, but he absolutely cares what happens in the market and the bond market during this term. And even with the Liberation Day, he put a pause on the tariffs because the bond market started to crash. And bond market crash is sometimes it could be worse than the stock market itself. But anyway, his economic advisors even warned Trump that the market would likely crash further if he moved forward with this decision. And guess what? The market quickly recovered when the Trump administration ended up denying any reports of firing Powell. And I think he was ready to fire Powell. But as soon as he saw how the market reacted, he just backed away from his decision. And that was just one of those things that I didn't notice. And I want to show you guys this clip here, because this is probably the most, probably the most hilarious video clip I've ever seen from the between the Fed and Trump. And take a look at this here. That is not it. That is me. 1 second here. That's this one. If you guys have seen this,
construction, and we're looking at the construction, and we're with the chairman, as you know. Chairman, come on over. And we're just taking a look at what's happening. You know,
just look how awkward Jerome Powell looks in this press conference. He was just like, being forced to walk with Trump and just kind of go, yeah, let's let me just put up with this for a little bit, right?
It's a tough construction job. They're building basements where they didn't exist or expanding them. And
it just looks like a lost little puppy. And I feel so bad. I feel so bad. And it's just like, man, this has got to be like going to the parent teacher conference and you know that you got an F on your grades. I'm not saying Powell got an F, but just you got to explain it to the teachers on what you need to do, and probably the most hilarious one was right here when he pulled out the paper.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1,
3.2.
This came from us.
Yes. I don't know who does that.
Are you including the Martin renovation? You just added.
our entire capital.
Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no,
including the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look.
Yeah, I mean, I just had to show this click. I've never seen anything like it. Really, just kind of like, man, just Trump just decided to visit Powell at the construction site where the Fed is doing its building renovation, and that was probably the most awkward interaction I've ever seen. So, man, I'm saving that clip for the future. But let me show you this. I gotta share a different screen here. Okay, window. All right. So, not it. Okay. Get it together, Sai. All right, there we go. So, could the Fed change its mind today based on all that and surprise everyone by cutting 25 basis points? I don't see them cutting 50, but could they surprise us? It's a possibility, right? And just take a look at the JOLTS that came out yesterday. And JOLTS stands for Job Openings and Labor Turnover Summary or Survey, which helps gauge labor demand. And the unemployment rate that comes out on Friday that measures the supply side of the labor market. Okay, so the JOLTS report will give us a better look, better indicator of a solid or weak labor market. And job openings declined in June while hiring also decreased. And this is another sign of slowing in the labor market. And this could be a strong argument within the Fed and the Trump administration to cut the interest rates as soon as possible. Not that the Trump administration has any say in it, but the Fed is pretty divided right now. And half of them could just argue and say, we need to start cutting rates now. And the new data showed 7.44 million jobs open at the end of June, which was a decrease from the 7.71 million from the month prior. And the JOLTS also showed that 5.2 million hires were made in June, and that was down from 5.47 million in May. And that decreased the hiring rate from 3.4 to 3.3%. And it is the lowest level since November 2024. Unfortunately, we're not getting the labor data until Friday when we find out the supply side of the labor market. And the unemployment rate fell to 4.1% in June. That was from 4.3 to 4.1 in June. And economists are expecting an increase to 4.2% on Friday, right? And the CME group right now, let me go ahead and refresh this real quick just to make sure that nothing has changed. Yeah, but still the same, about 97% chance that they're going to maintain their interest rates at 4.25 to 4.5% today. So people are going to be like, why is Sai even doing the live stream today? Well, again, I want to see what Jerome Powell has to say about, he's not going to say much about Trump, but the decisions behind it, how the tariffs are kind of like are factored into the decision-making process and the labor market. And some people believe the Fed is going to do a surprise rate cut today, but I don't see that happening at all. And I personally think the Fed should cut interest rates today because the CPI is probably going to stay between 2 and 3% for the remainder of 2025. But that's just me, right? I don't really get to make that. I don't get to vote on that. Anyway, and the market thinks there is, if you take a look at September 17th here, that's the next Federal Reserve meeting, they are still there's a 58% chance that the Fed will start cutting interest rates on September 17th from 4% to 4.25%. And this makes more sense because Jerome Powell has repeatedly said in the press conference in the past that he wants to wait to see how the economy and the labor market turns out in the summer months. Okay. And we're about to be in August right now, which is mind blowing. I don't even know where 2025 went. So the Fed probably wants to see more economic reports before cutting interest rates. And remember, there's almost a 2-month gap between July and September. And, there are going to be more reports coming out between today and September 17th, right? And if you take a look at October 29th here, and the meeting, that's the meeting after September 17th, there's a 28% chance the Fed will cut another interest rate to 3.75 to 4%. And if they don't do anything in September, right, then they could just cut the rates in October and December here. And right now, the summary of economic projections are showing 2 rate cuts possibly for 25 basis points, but they could end up not cutting any interest rates at all in 2025, which would be very unfortunate. But they could even surprise us in December and say, whoa, economy's going through some serious headwind, and just cut interest rates by 50 basis points in one meeting, right? And some economists, they still believe that there's going to be at least 1 rate cut. I think 1 rate cut is probably more probable now. As much as I like to see 2 rate cuts, but I think it's going to be probably around 1. And that's if the unemployment rate just remains steady at between 4 and 4.3%. But if it goes up to like 4.5, 4.6, and there's a steady increase in unemployment, then the Fed could be like, all right, it's time to, start cutting rates. Trump is not going to like that, right? Anyway, the drama behind Trump and Powell. So Powell's term is going to end in May 2026, but he can stay on as Fed governor until 2028 if he wants to. I'm thinking that he is going to stay on. He's a pretty stubborn guy, right? And Trump is possibly looking at these candidates to possibly replace Powell as early as this summer, is what they're saying. And he can announce it whenever he wants. And they call it the shadow Fed because they could just undermine the Fed by saying that this is going to be my next guy, but he is not looking to replace Powell for another 10 months. But the market's probably going to shift their attention more on the new Fed that's going to replace Powell. And that's why they call it the shadow Fed. And based on the CNBC survey, there's a 24% chance that the former Fed Kevin Walsh could be the next chairman. Scott Bessent, I'm sure you guys are familiar with him, the Treasury Secretary, also has a 24% chance of becoming the next Fed chairman. So obviously Trump is looking for an alliance, right, within the Fed. Kevin Hassett, he is the director of the President's National Economic Council. He has a 22% chance of becoming the next Fed chairman. And the current Fed governor, Chris Waller, who's been very vocal about cutting interest rates, has a 14% chance of becoming the next Fed chairman. And what they all have in common, again, is that they're all aligned with Trump's agenda to cut interest rates as soon as possible. And the survey said that there's an 84% chance the president would not fire Powell before his term ends in May 2026, because it's going to become a legal nightmare and a huge swing in the stock market. Okay, so what does this all mean for the stock market in 2026? The market will likely start pricing in more rate cuts in that year in 2026. When I say pricing in, the market probably starts to go up. That's my prediction towards the back half of 2025 to prepare for the rate cuts in 2026. It really depends on who gets selected for the Fed chair. That's my guess, right? And who benefits the most from a low interest rate economy? Small cap stocks. Small cap stocks beat the S&P 500 in 2020 when the Fed funds rate was at 0% during COVID. And people are going to be more risk on if they could borrow more money to invest at a lower interest rate, right? If the interest rates come down, let's say the Fed funds rate come down to like 3%, you bet your butt people are going to start taking out margin loans to invest more, taking out a HELOC or taking out other types of loans. Not that I do any, any of those, but people will want to take more risk because the interest rates are low to invest more, right? That's just another possibility. It could benefit the home builder stocks if it can attract more buyers when the interest rates are lower as well. And let me ask you this: would you buy a house right now if the interest rates were at 5%? You probably would, with how the interest rates have been higher at 6.5, or 7%, right? What if the interest rates were lower to 4%? Absolutely. People are going to go out there and start buying homes, right? And how many homeowners who purchased homes since 2023 would refinance from 6.5 to 5%, or maybe down to 4.5%? Probably most of them will lower their payments. And would you buy a house if the interest rates were at 4.5, or build a house, not buy a house, but build a house if they were at 4.5% or 5%? I would. If you take a look at Toll Brothers, they're offering like 4% or 4.5% for the special mortgage rate. It's like a home builder mortgage rates or something like that. But yeah, take a look at how those home builders are trying to attract more buyers by bringing down their own mortgage rate. So that's really interesting to see. They're eating the cost on that. And what am I doing as a FIRE investor in the meantime? I am always going to make sure to have a healthy cash position to deploy to the stock market if we see another crash like we did on April 2nd for the Liberation Day, right? When the market is up, and it has been going up for a while, that's when I start to build more cash position to make sure that I am ready to deploy that whenever the market starts to make some corrections. And I'm always dollar cost averaging. I'm not piling up my cash and not investing at all. I am always dollar cost averaging by investing in the market every single Friday. And I've been doing that for many, many years. And I don't care if the market is up or down. I have a set amount going into my 401k, HSA, Roth IRA, and taxable brokerage account, maxing them out, right? The only debt I have is my mortgage, and I'm going to keep it that way until I get ready to retire. And if you guys have been following me for a while, I used to have $110,000 in total consumer debt way back in 2013. And I'm never going to take out a loan, carry a balance on my credit card, or borrow against my 401k ever again. I never borrow to start this business. My YouTube channel or this financial planning business never took out of debt. I just put in like about $5,000 to start the business. Never had to take it out. I've just been reinvesting with the profit that I make, right? It's just one of those things that with my fundamentals is that, am I going to borrow money to buy a house? Absolutely. Am I going to borrow money to invest in an investment property? Yes, most likely, right? But that's just my fundamentals. And a lot of people feel differently about it. Hey, that's on you. But what I want to do anyway is pay attention to the Fed funds rates and invest in sectors that are underperforming. Am I going to put more money into the international stocks now? Probably not. They're already up. If you look at some of the international index funds, they're up like 18%, 20% year to date. But I am constantly looking for some of the weaker sectors. Small cap is slowly coming up, right? Mid cap and some of the specific sector ETFs. Do I invest in individual stocks? Absolutely. You can always see what I'm investing in my private community by visiting firestarter.com/community. And I need to post some updates on that too, probably soon. But anyway, now, we got 5 minutes left, so I want to just quickly show you what to expect between today and September 17th. Okay, so these are the data that I want you to pay attention to, and we're going to have the next inflation data, CPI or Consumer Price Index, twice on August 12th and September 11th, and PPI, that's the Producer Price Index, that's going to come out on August 14th and September 10th. And don't be surprised if the interest rates start to go down before the September meeting if the banks are pricing in more rate cuts than expected. Retail sales, that's going to come out twice on August 15th and September 16th. The GDP first estimate, so the Q2 GDP estimate just came out this morning. that was at 3%. But if the imports amount of imports were decreased from the previous quarter. But if you took out the imports year over year, the annualized rate is like around 1.6%. So it's not that great if you just took imports out of the equation. So we'll see how it goes. I know it's good that it's at a positive rate, but the economy is still not growing as much as I thought it would be. But anyway, and the next one is going to be PC inflation. That's going to be coming out on July 31st tomorrow and August 29th. And the Federal Reserve pays very close attention to this. And if Powell is considering anything, this is going to be one of the data points that he's going to be looking at. But don't be surprised if this comes out a little bit higher than expected due to tariffs. We're also going to get the JOLTS, which we talked about earlier yesterday, and another one that's going to come out on September 3rd. And if you're just now tuning in, JOLTS stands for the Job Openings and Labor Turnover Summary or Survey, which helps gauge labor demand, while the unemployment rate that comes out on Friday measures the supply side of the labor market. When you hear the headline of 4.1% unemployment rate, 4.2%, that's the labor demand, okay? So the JOLTS report will give us a better indicator of a solid or weak labor market. I pay attention to both, but this is something that you should know as well. And again, unemployment rate will come out on Friday this week and on September 5th, right before the next Federal Reserve meeting. And right now, the unemployment rate is at 4.1%, but if it starts to creep up to 4.4 or 4.5% or higher, then the Fed might need to do something to cut interest rates, pretty much right away. And remember, even just the 0.1% is a significant move based on our population. And the next FOMC meeting will give us the latest summary of economic projections, or SCP. And this is the same day the Fed will make its decision to either cut interest rates or maintain the rates where they are. And I'm going to be live streaming on that day as well, as kind of like a special live stream. And it's currently at 4.25 to 4.5%, but I believe it's probably going to come down to 4 to 4.25 if they don't cut rates. And it's probably going to be, if this is my personal opinion, if they do not cut rates by September, I don't think they're going to cut rates at all in 2025. I know that's a bold statement, but I am starting to think that this is going to be one of those years where people just go, well, that's 2025, and we're going to maintain the interest rates the same as it is. So let's listen to Bloomberg, my favorite channel here.
Kind of guy.
And they're about to announce that decision in less than 30 seconds.
A few years ago.
Hershey Hugs.
He was a hockey player for the
What is
Hershey
up from
Bears.
Jacksonville? I was just there in May. Jacksonville is amazing.
John, the tariff.
Thanks for being here, Chip.
John, the tariff.
Yeah, I don't think so either.
You're trying to keep us in line.
No, the tariffs. Bob, help me.
I don't know who works as a
These
fiduciary.
tariffs coming in here is
I
a
don't know.
revenue.
That's up to you,
gain for the
Jennifer.
country.
Just make sure that person is
They are. They're going to be trillions.
can walk you
of
through
dollars. All
the
you have to do
process
is
to
look
make
at
sure
the
that
CBO
that
scoring
person can coach
methodology,
you through
and it almost perfectly
what you need. So
offsets
make
the
sure to
incremental spend with the one
not
big
someone
beautiful
who's just
bill
trying to
act.
take
Bob
your
Michael's
money.
going to be sticking with us. The decision is about 30 seconds away. So here's the setup. Most people, no, almost everyone, expects no change in
It should
monetary
be
policy
out.
in about 30 seconds' time. However, there are some people who are expecting some dissent. One governor maybe. If you get two governors, it will be the first dissent against the chairman, going all the way back to 1993.
Yeah,
The decision,
they're going to keep
moments
their
away,
rates steady at
equities are positive by
4.25 to
0.25% on the
4.5%.
S&P
As always,
500.
Bloomberg is
On the
late,
Nasdaq
but
100,
I am already
up by
seeing the issue
0.4. On the
statement
Russell,
from
up by
FOMC
0.9.
committee.
Decision seconds away, 30 minutes
And
later.
they are going to
Chairman
maintain the
Powell.
rate
For now,
steady
let's
at
cross over
4.25
to
to
Mike McKee.
4.5%.
No rate moves, two dissents as anticipated, and no future guidance. The benchmark rate remains in a range of 4.25% to 4.5%, even though policymakers say that economic growth moderated in the first half of the year as, quote, swings in net exports continue to affect the data. Uncertainty about the economic outlook remains elevated, their statement says. They dropped the suggestion in the last statement that it had diminished. But there are no hints about about future moves. September is not mentioned in the statement. There's no change in their line about carefully assessing data, the outlook, and the balance of risks in considering the extent and timing of additional adjustments to the target range. At the moment, labor market conditions remain solid and inflation remains somewhat elevated. Those were the characterizations used in the last statement. As anticipated, Governors Chris Waller and Mickey Bowman dissented the first time, as John mentioned, that two governors voted against the committee decision since 1993. They preferred a 0.25 percentage point cut. Governor Adriana Kugler did not attend the meetings or vote on policy. The Fed says she is attending to a personal matter. Guys?
Mike McKee, appreciate it. Fantastic breakdown, as always. As expected by many of you, policy unchanged. Two dissents, two governors, as Mike repeated, the first time since 1993. In the first paragraph of the statement, the committee says the labour market remains solid. This is the issue that Governor Waller has with the labour market and that kind of communication and language. When he made the case to cut interest rates in the last few weeks, he thinks this is a labour market on the edge. Ultimately, at this meeting, he failed to convince the rest of the committee to go with him.
Although he did get another Fed governor, and I am curious to see what their justification is, especially after the ADP report, the better than expected GDP print, a whole host of other economic data points that have come out, as well as earnings that have continued to surprise to the upside more frequently than not. This is going to be very much an emphasis on why from their perspective.
I don't agree with the 3% statistic today. I think we're at 1.2% domestic final sales. I love what Jason Furman did with a 6-month moving average. And you mentioned Bob Michael, Feroli's at a 0.75 forward. I think the numbers are soggy. They were Trump-affilic numbers.
Let's look at the market. Equity still positive, but fading, up by 0.2% on the S&P 500. In the bond market, yields just a little bit higher. Look across the curve on a 10-year up by 2, on a 30-year up by 3. The price action could get mixed up in about 28 minutes time when we get this news conference with Chair.
Yeah, and Jerome Powell is going to get ready to speak in a little bit, but this is what they were talking about. The ADP private payroll data just came out. So that was this morning as well. I told you this week is going to be juicy with the economic reports. But yeah, this is the private payroll data, and it has increased by 104,000 jobs in July, and pay was up 4.4% year over year, according to the July ADP National Employment Report. The ADP National Employment Report is an independent measure of the labor market based on the, well, I'm not going to read all that, but it is just the private sector employees, okay, in the United States. Captures nearly 14.8 million individual pay change observations each month. So ADP private payroll comes out around the same time the unemployment rate comes out, usually before though. So non-farm payrolls are going to come out on Friday, and the ADP came out today, and we're going to get a better look on the supply side on Friday, right? So 104,000 jobs, that was more than expected. So this is something that the Fed could argue and say, well, you know, the jobs data looks pretty good. GDP came out at 3%, and people still have jobs. So why should we cut rates? And I'm sure Trump is going to be pissed in a little bit. This is the statement from the Federal Reserve. Basically, just maintain it. The committee decided to maintain the target range for the federal funds rate at 4.25 or 4.25 to 4.5%. In considering the extent and timing of additional adjustments to the target range for the federal funds rates, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. So it doesn't say anything about what they're going to do in September. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. So, so they're going to maintain the interest rates the way they are. In assessing the appropriate stance of monetary policy, the committee will continue to blah, blah, blah. Okay, so committee will be... All right, so two people voted against. So if you look at the bottom here, this is what Bloomberg was just talking about. Voting against this action were Michelle Bowman and Chris Waller. So Chris Waller is one of the candidates to become the next Fed chairman. So he is probably going to vote against it every single time They prefer to lower target range, and it is not unanimous. Everybody else, Powell, Williams, Barr, Collins, Cook, Gooseby, Jefferson, Musalem, and Schmidt, they all voted for keeping the interest rates where they are. So we'll see if anything came out from the Truth Social. Probably not yet. But in about 20 minutes, we're going to see Jerome Powell, and I'm going to live stream through that. Now, I definitely want to hear what he has to say. A lot of reporters have some good questions. If this is your first time watching this, and people ask me, what should we do if the interest rates are still remaining steady at 4.25, 4.5%? When you get to a certain point in wealth, I remember when I had like over $110,000 in debt, never cared about the Fed funds rates. I just never cared. It was just like one of those things like, why do I even care about what the Fed has to do? The interest rates were where they were, right? And that's not my concern. So that's something that I want you to remember, is that these are the things that you cannot control. These are the things that's just completely outside of your control. What you can do is start taking control of your finances. Okay. And that could be many things. And I'm talking about paying off your debt. When I say debt, I am talking about your car loan, your credit cards. Those are the things. Those are probably the number one and number two wealth killers, is that carrying credit card balances every single month and paying 20, 25, 30% in interest. I've done it, right? I had $47,000 in credit card debt with 5 maxed out credit cards in 2013. And it took me about 17 months from January 2014 to, it was like August or September it was like August 2015 to completely pay off my my credit cards, all 5 of my credit cards. It sucked. I didn't do anything for like 2 years, because that was my debt-free journey for 2 years, from 2014 to 2015. And as soon as I paid that off, I was still driving this piece of crap Honda Civic for a long time. Immediately after that, I paid off my personal loan that I had to take out for, I shouldn't say I had to, but in a way I did, because it was for my divorce at the time in 2013. It was like an $8,000 personal loan that I paid off. I borrowed against my TSP, which is something that I'll never do again. It's like borrowing against your future, right? Some people may argue that 401k loan worked out really well for them. Well, it's good for them. But at the end of the day, for me, when I go back, it's never worth it. And I've had clients ask me if they should just take out a 401k loan to pay off some of their credit cards. I'm like, so you're taking a shortcut. Sure, that's a great way to maybe just pay off your credit cards with high interest rates right away. But are you really solving anything if you're just kind of like, taking a shortcut? And who's to say that you're not going to build up debt again? That's one of those things that I'm like encouraging people to do, is don't just look and say, I'm going to take the shortcut and because I'm playing with the interest rates, but instead really find out why you got into debt in the first place. If you look at my private client program, I have some of the most incredible clients in my group, and I have permission to share this. I have a 74-year-old client. She is retired. She is on cruises, and at one point she had debt. And she worked with me for many months, and she's still working with me. And she is just retired, living her life, going on cruises, and she doesn't care what anybody else thinks, And she and I would work together to make sure that she got out of debt. She had a sizable cash position where she could last at least a year if the market, goes down or up. And she has a really good pension too, Social Security and some other pension plan that she has. And she's not even touching her investments. That's the most incredible thing. And she shared her 401k screenshot the other day. And I remember when she took that screenshot from 2022, it was down like 20%, right? If you remember, it was like 20% year to date from that year when the stock market was down. What is it? The bond market was down. If you're investing in TSP, you probably understand that too. But everything was down. It was crazy, right? And it was just one of those things like, man, she had that balanced screenshot. And then when she sent me another one this year, I'm like, holy cow, it's almost like it's gained like almost over 75% since 2022 because she just continues to dollar cost average. And she has some incredible stories. I try to get her to go on my channel to maybe talk about her life story, but she's like, nah, that's not something I want to do. I kind of wish that she would, but yeah, it is what it is. It's all good. But anyway, let's listen to some Bloomberg real quick, and I'm going to go through some Q&As here.
By the way, today the acceleration was in both goods and services. That is also worrisome for the Federal Reserve because it suggests that perhaps there may be some contagion from tariff inflation from goods tariff inflation into service sector inflation. And that is exactly what those who are most hawkish on the Fed are worried about. And that's the data we're going to get tomorrow morning. But it's in this data release that we got today.
Diane, I'm watching the long end of the yield curve, and I'm wondering how much the bond market's going to start to worry about a pickup in inflation on the back end of some sort of rate cutting cycle. You're not really seeing it in any kind of massive way. It is early days. We haven't gotten the press conference. How closely are you watching that indicator for a repeat of what we saw last year if there is this dovish tilt in the expectation of several rate cuts for the remainder of 2025?
Well, first of all, I think Chairman Powell is going to be very cautious on all meetings are live. We'll take the data as it comes in. We're wait and seeing, but he's not trying to do forward guidance here. That doesn't mean he won't say the meeting still could be live in September, because it could be live in September. He may not have enough information to telegraph that at the Jackson Hole Symposium, but the bottom line is he will be saying that all meetings are live. That doesn't mean the Fed will be cutting in September, and we actually don't think they'll be able to cut in September unless you see a very much larger deterioration in overall labor market conditions. We agree with the economy has slowed. Domestic demand has slowed. The economy is slowing as inflation's picking up. That is that stagflationary kind of environment that the overwhelming majority of the Fed has been expecting. And what they're waiting to see is which effects are larger ultimately. Waller still feels the margin of error is very narrow for the labor market. I can have sympathy and empathy for that point because, listen, hiring and the pace of hiring, the pace of quits, they're below 2019 levels. They're consistent with much higher unemployment rates. But as Bob mentioned, we have curbs on immigration that are going to kick in and create pockets of labor market shortages at the same time as we get into 2026. That's a very hard situation for the Federal Reserve and the threat of a more persistent and pernicious bout of inflation and why we don't have the Fed cutting until the end of the year.
Yeah, I will say this, that if the Fed does not cut interest rates in September, I don't think they're going to cut for the remainder of 2025. I think that's they need to see some data, like she said, is they need to see some significant data changes, like from PCE inflation, unemployment rate, ADP private payroll, non-farm payrolls, everything. And if they don't see any significant changes that warrant them to cut interest rates, I think they're going to maintain the rates where they are. And Trump is going to be pissed even more. Let me see if he put anything on the Truth Social just now. I don't think he has. But I just don't think that they're going to cut interest rates if they don't do anything in September, if I had to guess. So let me see. Why are there so many pillow commercials? Let me see. 3 hours ago, nothing. Yeah, nothing so far from Trump. I'm sure he's going to post something later on. But the earnings have been great, too. Wingstop. They're okay chicken wings, and they just posted record earnings. Yeah, they're opening more stores. I talked about SoFi on my in my private community, and their revenue and net earnings are just some of the most incredible income statement that I have ever read. I shouldn't say ever, but I've seen some incredible ones too. But SoFi is doing really well, and there are a couple other stocks that are just kind of outperforming. And small cap is something that I have been paying attention to. So I'm kind of curious to see where that goes.
As you go into this news conference in 15 minutes' time, Mike, I imagine you're starting to think about questions to ask the chairman. What kind of questions do you want answered this afternoon?
Well, I think one of the most important questions, John, is going to be whether anybody else on the committee, even if they did not vote or did not vote to dissent, agreed with the Waller and Bowman position. Is there more of a move in the Fed towards a cut than we had seen? We also want to know more about what they're thinking in terms of the bigger danger. Is it unemployment at this point? Is it the labor market, or is it inflation? They were very sort of anodyne, not changing much their analysis of either one this time. The big picture that we're missing right now is the labor market, because it's still, as they say, solid, but that's backward-looking data. We don't get the latest until Friday. The inflation numbers, as Diane mentioned, we can also already pretty much calculate, and we know it's going up. The GDP numbers today, one question is, the business spending numbers were dismal, but was that because companies are sitting on their hands waiting for tariff decisions? Or is that because they've decided now that they're going to pull back because the economy is slowing down? A lot of unanswered questions. I'm not sure how many Jay Powell can give us answers to, but those are the kind of things we might see in the press conference.
Mike McKee, thank you, sir. We'll let you run. Mike McKee there, with the breakdown of the Fed decision. The objective of Chairman Powell has to be to make this boring. This should be boring. And as someone said to us earlier on this morning, if the most entertaining thing about this is 2 dissents, then this is a boring meeting at the Federal Reserve.
There is not going to be anything boring about this press conference, because Fed Chair Jay Powell has to message why this committee that has been noted for its consensus suddenly is breaking apart, and why people believe that there is a shadow Fed, effectively, a shadow Fed chair in the likes of Chris Waller. Interesting.
I talked about that shadow Fed
Question of whether Chris Waller is being taken more credibly, and whether people are going to hear what he has to say more directly.
I think Diane handled that perfectly.
She was beautiful.
Absolutely perfectly. Neil Dutter's much more fiery. He writes this: using tariffs to absolve yourself of doing anything is downright pathetic. So Diane, naturally, I've got to ask you whether you think it's downright pathetic, and whether you do think they're using tariffs to absolve themselves from doing nothing.
I think tariffs are an unknown. The rollout has been uneven. There's more of them coming on Friday. We know the effective tariff rate is lower than it actually should be right now, and that's because firms are using bonded warehouses and free trade zones to not have to pay the upfront costs of tariffs. But over time, we're starting to hit a tipping point, and that's what you're seeing in the Fed's Beige Book. That's what you're seeing in their surveys. They're seeing that the effects are starting to come in, and coming off the heels of the pandemic-induced inflation, which frankly we have yet to fully bring down. That is important as well, because that proximity, as Jim pointed out earlier in the show, this is a different environment than it was in 2019. And that proximity to that inflation that is still with us from the pandemic, that's important.
Diane, give us the dynamic of our nominal GDP, our animal spirit. You mentioned stagflation, but if I got real GDP coming down, I don't know what inflation's going to do. Do you just assume a more dampened nominal GDP? Is that the heart of the matter, like the crater in fixed investment that Mike McKee talked about this morning?
So yeah, what we have is the overall economy basically moving sideways in the second half of the year, not much more than that. That's slower than the first half, but not a lot slower than the first half. This is a major slowdown in the overall economy as it deals with the disruptions due to tariffs, among other things. It's been destabilizing. There's an uncertainty factor. If we get more certainty, we should get more investment as interest rates finally do come down in 2026, and you do get some of the stimulus from the One Big Beautiful Bill Act coming into the economy. Those things we know are out there, but it really is the second half of this year has a lot more headwinds than the first half did. And the first half was not insignificant given all of the hot air we've seen on tariffs.
Diane, appreciate your time.
Yeah, one of my private community members just asked me, just kind of like, during the tariffs, the business, how you run the business, do I ever take out a business loan to run my business? I do not. This is a debt-free business, I like to call it. My initial investment into this business was about $5,000. But if you're looking to expand your business and you're trying to look for certain loans to help you get started, what I would like to caution you is this. Is do not bite more than you can chew. That goes with any, let's say, credit cards, right? People are in credit card debt because, one, they bit more than they could chew. no matter what the situation was. It could be an emergency situation. We don't use credit cards as an emergency fund, but it's use it, pay it off every single month. That is the common sense that we use in the fire community. Not that I had any common sense back in 2012, 2013, but those are the things that we learned along the way. So if you are going to take out, like, say, a business loan to maybe boost your business or purchase more supplies, make sure that the demand is there first, right? If I am going to expand, if I'm going to hire somebody right now, and I have 5 people under me right now, and if I am going to hire somebody else, that person needs to be either 2 ways. Okay, one, he or she is going to generate more revenue because that person is going to fill a position that's going to save me, that's going to create more sales or something that's going to generate more revenue. Okay, but got to make sure that's one of them. And number 2, the other way of hiring someone else to do the job is to save time so that you can open yourself to other opportunities, or other projects that you may need to do as a CEO, or you're trying to expand your business, whatever that may be. Oh, that's a really good question too. So like when I think about hiring someone, or if I'm going to take out a loan, not that I'm never going to, but if I'm going to take out a loan to do something, I need to make sure, one, the demand is there, and number 2, it needs to make sense that I can pay this off within 12 months, or if I can pay this off within 24 months. I'm not going to borrow my way out of a bankrupting business where, if this business, let's say people don't want to talk to me anymore and get that consultation, 60-minute consultation, and the private client program, everybody quits from the private client program, then my business could be in trouble, right? But is there another source of revenue? Is there something else going on that's more likely a core business issue? If I borrow money to try to pay for all these expenses and I don't fix that core issue, then I'm going to put myself into debt, into a situation where I can't repay the debt. So that's something that I want you to remember when it comes to running a business or taking out a loan for anything, is that, one, do not bite more than you can chew. And number 2, make sure that this is within the limitation that you have set at the beginning, so that you don't end up in a situation where you cannot repay the debt, or you just get stuck in that. Let me go back a little bit. If this is a revenue problem, don't take out the debt, right? If you're taking out a debt to increase your supply to meet your demand, that's understandable. But just something to keep in mind. In the meantime, let me show you this real quick. And I know we're going to go into the press conference in about 5 minutes, but you can go to firesuch.com/resources, and you get the free financial independence checklist. This is more on the personal side, and there's a checklist for the businesses, for business owners. But number 1, calculate your fire number, right? Whether you want to do the barista fire, coast fire, you want to do fat fire, that's what I'm on, lean fire, or traditional fire. You need to first understand your burn rate, right? People who are in debt, I would say that you need to budget. If you're trying to pay off your debt, you need to do that zero-based budget, which means that you need to put your balance down to 0 and then pay off, put whatever you have remaining on your budget towards the debt. When people are working on fire, I would say work on your cash flow. So you're still budgeting, but you're making sure that there's a cash flow coming in where you automatically distributes all of your money. Let's say you get paid $10,000 a month, and you put 50% of that into all of your investments. You put 10% of that into your cash position. You put the remaining 40% into expenses. I know some people in the comment section will be like, I don't know what the heck he's talking about, making $10,000 a month. Nobody makes that. Welcome to the FIRE channel, buddy. This is the financial independence channel. So this is something I use a higher figure because, in order to achieve FIRE, you need to have higher income. No matter how much you cut your expenses, you still need to have higher income. But anyway, if you make $120,000 a year, right? How fast could you FIRE? You don't know that answer until you calculate your FIRE number right there, the first step, right? The next step, rainy day fund. Step number 3, employer match. Get up to the employer match. The next step, pay off your debt. So up to step 4 or step 5, when you hit that emergency fund on step 5, you are budgeting. You're always budgeting to make sure that your money is properly allocated to your expenses first. That's where you're prioritizing. You're prioritizing your expenses. And number 2, you're going to priority number 2 will be your savings and investing. Okay. Once you get to step 6, you go to HSA and Roth IRA because you're already debt free, maybe except for your mortgage. Then you can start working on your cash flow statement. You want to look at your monthly cash flow statement to see, number 1, what is your average burn rate? The burn rate for essential expenses, let's say that's going to cost you $3,000 a month. $3,000 a month is what you need to survive on. Okay. It's completely doable. You're like, I live in San Francisco. I can't, $3,000 a month is not enough. You're probably right. But have you really looked at what's needed and what's wanted, right? That's what my private clients and I work on, is the dividing between discretionary and non-discretionary expenses. Understanding your burn rate and see how much you start maxing out your HSA and your Roth IRA, because your retirement investment accounts, those are going to be the priority no matter what you're doing. It doesn't matter if you're on Lean Fire, Fat Fire, Barista Fire, Coast Fire, you still have to prioritize your HSA, Roth IRA, and 401k, because those are the 3 main accounts. Or if you have TSP or 403b, those are the ones that are going to grow tax deferred or tax free. Roth IRA is an example. That's going to grow tax free. If you don't have an HSA, that's okay. You can skip that. But HSA also grows tax-free too. And that's why you need to kind of prioritize those before you even get into the taxable brokerage account. And I talk about those different accounts, like, different fire age. If you want to retire by 40, you may need to prioritize a little more towards the taxable brokerage. But does that mean that you should stop investing into the HSA, Roth IRA, and 401k? No, you need to do more than that, because I don't want you to miss out on the compounding growth between 20s, 30s, 40s, and then into 50s, and you want to retire at 50, you have nothing in your Roth IRA or 401k and all your assets in a brokerage account. Remember, taxable brokerage is taxable on capital gains. 401k, or let's say Roth IRA is an example. It's tax-free when you're 59 and a half. You still have to make sure that you have the tax-free assets, tax-deferred assets, and after-tax assets. So those are the bucket strategies that I have talked about in the past. And I want to make sure that this is kind of captured. But go to firesightshare.com/resources, and you'll get the free FIRE checklist. You'll find some financial independence checklists on there, financial independence calculator. There's a savings rate calculator on there. That's all the free version that you can take a look at. What I want you to remember is just no matter what the market is doing, I need you to do this first, your personal finance. Let's forget about all the overall economy, but I want you to focus on your personal finance. You can always schedule a session with me by visiting firesightshare.com/consultation and schedule a 60 minutes. You cannot become my private client without going through that first. So just take a look when you get a chance, and the link is going to be in the description below. Okay. And he is about to speak. So let me go ahead and unmute this.
In about 60 seconds time, the chairman walks through that door. He'll stand in front of that podium and he'll make some comments for the next 60 minutes and face a ton of questions about why they didn't cut interest rates today, how he's handling the dissent. And Mike McKee puts his hand up and Bob slipped him an email. What do you want Mike McKee to ask this afternoon?
I think you have to nail him on inflation. If they're so sure that the impact from tariffs on inflation will be transitory, and he said that in the past, why not go ahead and start bringing rates down, 25 basis points or so? Go with the 2 dissenters. 30 odd years ago, the 2 dissenters proved to be right.
Bob Michael of JP Morgan Asset Management. Bob, thank you, sir. Appreciate
Happy to be
it.
here.
Solid question for the chairman in a few minutes' time.
Yeah, and if CPI is the most important, you aren't going to see the consumer tolerance to it for quite a while. Well,
he's late. This is interesting.
You don't
He's
get
never been late.
time.
Bob Michael should be in the press conference. The wow statistic today is JP Morgan with a modeled 18% tariff rate. That changes this entire dialogue.
There is a question as to whether we've seen the test just yet. Peter Chirv Academy is making the argument that we haven't had the tariff test. All of that pre-tariff inventory that we've been working our way through, the fact that it's been escalating slowly, and maybe by the time we get to September, that test is a whole lot bigger. Here's the Federal Reserve Chairman, Jay Powell, stepping in front of the podium for today's meeting.
Remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go. Questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information. And, I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many, many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge, but it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning, we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report you get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market? So
let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. we're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works. And that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic, expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates.
I like that guy too. He's from the Wall Street Journal. I do follow him.
I mean, I wouldn't insist upon that, but
Nick,
I don't think. I think
the
base case. As I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges.
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals. And that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guido with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now.
And we went through the very long
process of clearing it through historic preservation at the National Capital Planning Commission. And a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation, sometimes early in the year, and then inflation turns lower. And a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay. The other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy, and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward. Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait and see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait and see approach is giving.
The wait and see approach. What do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait and see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. And we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down?
I think
closer to 2.
We'll look at everything. It's as I mentioned, a pretty reasonable base case is that this will be a one-time price increase, and in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that. But if we had to make,
I think that's pretty good. Just kind of muting him for a second, but he just kind of indicated that the next meeting could be closer to neutral. He didn't say September, but he said that we are getting closer to neutral. So that's going to bring up the probability of rate cuts coming up.
Concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically.
Based on that comment alone by Powell, the CME group just raised the probability of the rate cuts in September to 52%. So that's something to keep in mind.
Outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned
too healthy and they're
high-end
in debt.
delinquencies. I don't know what to make of that. I read the same thing, but so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to. And there's no question that it's slowed. And, we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this dissent, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report, we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, which it may be even low, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor forces is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits. Look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go around where people talk about the economy, and then to that's yesterday. And then today we have a monetary policy go around all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target. Maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons they'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondered if you look at that, you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Last question of the day.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Oh, man. That was like...
The chairman
savage
of the Federal Reserve,
finish.
his words. This was one of the better meetings that I can recall.
Okay.
Maybe you
All
had
right.
to
So that pretty much sums it up. And as expected, they didn't cut any interest rates today.
Man, stuff in my throat, I guess, so to speak. But they decided not to cut interest rates. But there were many indications that they are looking to possibly cut interest rates in September. And there's going to be a break in between today and September 17. There's a whole month gap, right? So they're going to see 2 data points. They're going to see data points coming up on Friday for the unemployment data. They're going to see several CPI, PPI, private payrolls, non-farm payrolls, unemployment rate, all of that between today and the next meeting, September 17th. So we got like about a month and a half, I would say, about almost 2 months. And they're going to be able to see a lot of data in between. And that's when they're going to be able to kind of say, all right, we're probably going to cut interest rates. But I still think that if the economic data comes in the same, let's just say that they are the same in September, I don't see why they would actually cut interest rates in September. And that's not what I want to see. But if they don't cut interest rates in September, I don't believe they're going to cut at all for the remainder of 2025, because they have been talking about the summer months for many meetings now. Since the March FOMC meeting, they were talking about it. They wanted to see what happens with the economic data, with the tariffs. And then they keep saying that we want to see more data points here and there. But there were some hints indicating that there's a possibility of going into the next step, more towards the neutral rate. So we'll see what happens. But this is one of those things that I do pay attention to as a business owner, as an investor, someone who has been on a financial independence journey since 2014, and just continuing to invest to achieve that fat FIRE number. These are the things that I do care about. Am I going to borrow money to invest more? No. But how does this look for the real estate market, right? Is it time to kind of start diversifying more into the real estate sector if the interest rates start to come down? And those are the things that I need to look at. How does this affect the small cap stocks? Those are the things that people don't really talk about, right? It's always about the S&P 500. I love the S&P 500. My very first ETF was VOO in my Roth IRA. And I was like, man, this, and I remember the price was like, it was like 180, no, it was like 170 bucks a share. And back then people were like, man, the S&P 500 is so expensive. Why would you invest in that? I'm really glad that I didn't listen to any of those people saying that you shouldn't invest in the S&P 500. I love the S&P 500, but now that I have been investing for a while, and I do pay attention to different sectors. Like, I don't want to miss out on the run, right? So if some of the prices, like the international stocks, are already kind of priced in with the recent tariffs and how the run has already gone up, right? With the 18, 19, 20% return, am I going to invest more into the international sector? Maybe a little bit, but not as much. But what I want to pay attention more is some of the sectors that have been struggling for a while, like small cap stocks, mid cap stocks, some individual stocks that I own. And I've been going through all the earnings reports. SoFi, something that I talked about yesterday in my private community. Again, you can go to firesession.com/community and get that 20% coupon code. And if you're someone like brand new to investing, consider going to that course, Fire Investing Academy, that I created earlier this year. And that coursework is always updated. And right now I'm in the middle of updating that course with the One Big Beautiful Bill that updated with our the tax codes and everything. So that's always going to be updated. You just purchase it once and that's all yours. And it's going to be updated on an annual basis or on whenever Congress passes a new law, like the OBBBA, right? But those are the things that I am looking at with the interest rates. And that's why I go live streamed to understand the monetary policy from the Federal Reserve. Congress is the fiscal policy, right? So they got 2 of them. And the Fed is an independent agency. If you go back to my channel, I've been live streaming this I don't know, probably a year and a half, maybe 2 years. And, I didn't start live streaming this because there's drama between Trump and Powell or the Fed. It's just happens to be that way. So, but check it out. I will be back live streaming next Wednesday, and I'm going to talk about how to quickly save and invest $100,000 to get to your financial independence number, because $100,000 was the very first milestone that I had to achieve in order to do anything, really. Just kind of like 100,000 was the grind that I had to get to. And I want to talk about that in next Wednesday's live stream a week from today. But enjoy that coupon code. If you want to sign up for a consultation, you can. It's a little backed up right now. I apologize in advance. If you go to the sign up page, the calendar, after you make the payment, the calendar may be more towards middle August or towards the end of August. So if you don't see something, or if you want to look for something specific, like, you want to know the dates that are available, just email my team at hello@firesidechat.com. Okay. But anyway, with that said, I will see you next Wednesday for the live stream about how to quickly save and invest your first $100,000.